Hi, I'm Michael Newrock, and today's lesson is on balancing risks and rewards. This lesson is all about being in control of your trading and not letting your trading be in control of you. And when you have the right balance between risk and reward, the natural outcome of that is that you are going to be more in control. And that's what this is all about, being in control. So let's begin. To start off with, ensure at least a 1-to-1 win-loss ratio. In other words, a 1-to-1 reward-to-risk ratio is the other way that you can say it. So if you're risking, say, 20 pips on your trade, then you want to be generating at least 20 pips on your win, preferably more. But it all depends on the market situation, what time frame you're on, and of course, if your target is struggling, or in other words, if the price is struggling to get to your target, then don't let your ego get in the way of a good, profitable trade. We'll cover that in a little more depth in a moment. But the bottom line is, when you set up your trades, when you enter your trades, place your stop and your target on at least a 1-to-1 ratio. Even better, 2-to-1, 3-to-1, 5-to-1. Forex Precog is a trade following system. It's a trade catching and following system. So it's not abnormal, it's not unusual for you to generate much more than a 1-to-1 reward to risk or win to loss ratio. And we'll cover that a little bit more, how you can do that. But at the very least, when you enter a trade, it must have at least a 1-to-1 win-loss ratio. Whatever happens in the trade, happens in the trade. Things change, and you need to be able to adapt to the market. Okay, you're not in control of the market. You're in control of your trading, but you are not in control of the market. And the market can change very quickly. For example, if you were going out on a picnic with your family and it's a beautiful sunny day, it's morning, everyone's good, everyone's happy, kids aren't fighting, you get to the picnic and it's all good. But within 45, 60 minutes, you're having a great time, but you start to see dark clouds come up over the hill. As you monitor them and keep watching, those clouds continue to come toward where you and your family are having your picnic. Now, you intended on staying there for the whole day for, 5-6 hours. But what do? Those clouds are looking really dark. You hadn't intended it, but that's what the day had intended. You just didn't know about it. So my point is that even though you may go into a trade with the best of intentions and have a perfect setup and have your stop loss and your take profit on at least a 1-to-1 reward to risk or win to loss ratio, be prepared for the unexpected and be prepared to adapt. Enter into a trade accepting a potential loss and adjust your risk to your tolerance. So take the picnic example. Be accepting of a flat tire, for example. I mean, things happen. So when you enter a trade, accept the potential loss and adjust your risk to your tolerance. So what I mean by that is that if you're risking $100 on the trade, if it goes bad, it's just a total flop, then be prepared to accept that loss. So if you have a $10,000 account, for example, and you've set your stop loss for so many pips and your lot size accordingly, you've worked it all out and you're risking $100. Be prepared to accept that loss. It's just part of business, okay? And when I say that, I mean you should be considering your trading as a business, as I've previously gone over in a recent daily lesson. We always go in believing in the best, but accepting the worst, okay? We need to trade on a high probability basis. And when we do get a winner, to make as much from it as possible, but be accepting of a potential loss every time you go into a trade. Okay. And the best traders, when they go into trades, they're not thinking all blue sky and glazed eyes. I'm going to make a home run on this one. I'm going to make a fortune on this trade. They go into the trade accepting the potential loss, because if you're not trading, there's no risk. The moment you enter a trade, you're accepting a risk. So adjust that risk to your tolerance. Are you going to tolerate 1% of a loss of your account, 2%, 3%, 5%, 10%? The point here is not to discuss the percentage that you should be trading on each and every trade. but that you should adjust your risk to your tolerance levels. Think about it another way. When you enter that trade, 5 minutes before you enter the trade, let's say you've been looking at this trade for a while, you've been waiting for the perfect setup to happen on a particular pair, and you decide to risk $200. Okay, you're obviously going for the win, but at the end of the line, you're risking $200. How will you feel if you come back to the trade 2 hours, 5 hours, 10 hours later, and it's failed overnight? You wake up, where's your trade? It's gone. It's not on the chart. It was a loser. Can you live? Can you accept the fact that you've lost $200 in that particular case, or 100 or 500, whatever it is? Adjust it to your risk, okay, your level of tolerance. If you adjust the pips of stop loss, adjust your lot size to control the total risk. Okay, so if you adjust the pips of your stop loss, what I mean by that is, let's say you want to give the trade more room to move, or you're trading on a bigger time frame, and normally you set your stop loss for, say, 20 pips because you're more used to or thereabouts, you're more used to the 5 or 15-minute charts, and suddenly you're on a 1 hour time frame or a 4 hour time frame or even a daily time frame, but let's say a 1 or a 4 hour time frame, and you need to set your stop according to the rules. If you're buying below the precog ribbon, and you do that, and then you realize, holy smokes, that's 50 pips. That's no longer the 20 pips that I'm used to. Well, in that case, actually, let's look at a different, easier example. Let's say you normally set your stop for around 20 pips, but in this particular case, you're setting your stop for 40 pips to adhere to the rules. What that means is you need to halve your lot size to have the same risk. So if you're risking $200 on 20 pips based on your lot size, then you need to halve your lot size if you're going to double your stop loss to 40 pips. Okay, there's two numbers in the calculation of what the total risk is going to be: the number of pips and the lot size that you are risking. So another way of looking at it is, if you're trading, let's say it works out to $1 a pip, that's the easiest example, and you're risking, say, $100, but suddenly you have to double your stop loss size, then you want to halve your lot size to half a lot. So if you do lose on the bigger stop, you're not going to lose any more than you would have lost normally. You're still at $100 risk. Have an exit strategy. Now, when you enter a trade, just like the example I mentioned before, the dark clouds coming over to spoil your picnic, you need to have an exit strategy, okay? Don't just look at it like a, fill in the blank. You need to have an exit strategy. So if you've entered a trade and then suddenly the rules that you use to enter that trade start reversing, you're buying a trade and suddenly the precog predictor turns red, and or the precog ribbon turns red, and then precog pro momentum indicators start changing color from yellow and gray for a buy to red and red. The MACD falls below the zero line, and you know that it should be above the zero line to be supporting price, which you want if you're buying, or the precogs themselves start changing from a buy only to a bidirectional signal, or even worse, a down only signal. Then you need to have an exit strategy, and you need to get out as quick as you can. Now, there's two ways of doing that. You can tighten your stop dramatically. So if some miracle occurs and it continues to go in the direction that you initially intended, great, then count yourself really lucky and then get out of it as quick as you can. But if it continues to go against you, you're not going to lose as much as what you had initially placed. The other way of looking at it as well is that on a price action basis purely, if price drops on the next bar you just opened, and within seconds or a couple of minutes price has a big failure and you're buying, this isn't a good thing. So it's immediately under pressure. So you need to once again have an exit strategy. Either get out then and there, or not every trade goes in your favor from moment one, or tighten your stops. That's all you can do at that situation. But if you have an exit strategy before you get into the trade, at least you are maintaining control of your trading, okay? And your trading is not controlling you. You have a plan, and you have a plan for different scenarios. Know when to take profits. Now, when looking at your charts, and we're going to go over this in a lot more depth, but again, if you're buying, you want to look at the recent highs, recent swing highs, and place your take profits just below those points, okay? A few pips below, depending on how far away it is. If it's 100 pips, then you've got plenty of room to move. You might want to set it, 20 pips below and go for 80 pips. And in that case, you won't even need to set your stop typically to 80 pips. I mean, if it's just under the ribbon and you're adhering to the rules and you only need to risk 15 or 20 pips, great. It's all about risking small for a big reward, okay? 1-to-1 is the last thing you want to do. That's the very least you want. Preferably when you go into a trade, you always want to go into a trade of being able to take big profits while risking small. So know when to take profits, know where to place them, and know when to take them. Don't let your ego get in the way of a good trade. You might be just a few pips away from your target, and if it's struggling, you can see, it's a body language. From experience, you'll get to know this, and by attending the webinars and being part of the group of same mindset traders, you'll become a better and better trader, I assure you. You just need to apply yourself and put in the time and effort that this deserves. Know when to take partial profits. Okay, so a profit isn't a profit unless you've banked it. Okay, otherwise it just becomes a hard luck story. I was $250 up, and then something happened, and well, that's not a profit until you've banked it. Okay, you're building up your equity, but you're not building up your capital. So know when to take partial profits. You don't have to close out of the position totally, and I certainly wouldn't, because when I'm in profit, I want to make as much money from it as possible. You're not going to win every trade. That's the point. So when you are on winners, you want to maximize the return that you're going to generate from them. But it's always nice to put a little in the piggy bank, build up that capital. So take partial profits. Now, if you just got one position open, it's a little more tricky, but you can close out 20% of your position or 50% of your position and still be in the trade. If you've got two positions open, it's much easier. And we'll go into that into a lot more depth. But know when to take partial profits. And the right time to take partial profits is when you're in profit and you want to put some money away into your capital. Build up that capital. Always be focused on building up your capital. Okay? If it's close enough to your target and you're happy with that, you can live with it, take the money. And know when to take profits early. Some trades just aren't going to go exactly how you had intended them to go, how you envisaged them to go. Okay, so for example, if you're buying, I'll stick with buying, it's the easiest way to relay the examples, but if you're buying a trade and when you got in, it looked like the momentum was strong. The ribbon was sharp, the predictor was going up, everything was good. MACD was well above the zero line and above the signal line. It's looking hunky-dory, looking great. But then suddenly it starts going sideways and still going up, but it's going really, really low. And this is the candle formation that I'll show you on a webinar, which I like to call, it's not the technical name, obviously, but walk up the stairs, jump out the window. And you'll know what I mean when you see it. You'll see a very gradual incline going up, and then boom, the price just drops. And if you're buying, that's not a good place to be, okay? So if you see that the market is not moving in your favor as quickly as you would like, take your profits early, or at least tighten your profits. Tighten your stops so you can lock in profits. You'll hear me say that again and again and again. Lock in your profits. If it goes against you, fine. You've added to your capital. You've built up your capital. And profits aren't profits until you have banked them, okay? Money in the bank, that's what you need. And that does not happen until you close your trades. Know why and when to exit a trade early, okay? And I've gone over a couple of examples already about that. So if conditions have changed, if the clouds are forming and coming over, if the trade has just taken way too long to manifest into a good trade, if the trade went against you to start off with and then goes in your favor and you're in profit, well, it's like a bad relationship. I don't want to give it too much benefit of the doubt. If it went against me once before, it's like a crazy dog. It's bitten you once, then you're going to be a little hesitant in trusting it fully again. Okay, so if it's moving too slowly, If it's moving sideways, we only make money as traders if what happens? Either the price goes up if we're buying, or if the price goes down if we're selling. Whatever we're doing, if we're buying or selling, we don't make money if the price is going sideways. Okay? That's the time to exit a trade early. That's definitely a time. If conditions have changed and your indicators, the software is telling you, the precogs are telling you, it's changed from a buy only or a sell only to a bi-directional, good first alert. If it's moving too slowly, if it went against you at the beginning, okay, they're the three main times. So once again, through experience, you will learn why and when you should exit a trade early, and you'll be glad that you did it. Okay, no point staying in the trade hoping. Okay, hope in trading is a four-letter word. Hope as much as you want. But when you trade, you need to be confident of your trade. You need to have a compelling reason of why you got into that trade in the first place. And you need to have a reason and be accountable to yourself, your loved ones, your peers, and me, why you are still in that trade. If it's going gangbusters and you're making huge profits and you're managing it well, then great, stay in the trade. But if any of those other situations are happening, know when to leave the party early. So grow your capital as well as your equity. And I've covered this a little bit already, but the big difference here is capital is the actual money in your account that is not in open trades. Okay. Your equity is what's in your open trades. So let's say you've got $7,000 in your account. Okay. You haven't taken a trade. You open it, it's $7,000. That's your capital. That's what you have to work with. You've opened up a trade. A few hours later, it's going really well. You're up $350. You're writing in the forum, gee, Michael, I love you. This is fantastic. That's your equity, okay? I'll be happy for you, but I'll be even more happier for you when you bank that money, right? And let's say, for whatever reason, you decide to close the trade, $350 up. Then your capital's gone from what? From 7,000 to 7,350. Okay. Now you're growing your account for real. Okay. Capital and equity. Make sure you understand the difference between the two of them and understand that by continually and regularly cashing in your pips, okay, banking your pips, whatever phrase you want to use, you're turning that equity into capital. And that's the real money. Are all your eggs in one basket? Okay, there's a couple of scenarios here. Let's say you're trading a pair, let's say the euro against the US dollar, and then you think this is good. You know what? The same setups happened on the pound. Oh, and the same setups happened on the Aussie and the Kiwi. I'm going to buy all those pairs. Problem is, you got all your eggs in one basket. All of those pairs, the euro, the pound, the Aussie, and the Kiwi, in those particular pairs are compared to the US dollar. What happens if something dramatically happens to the US dollar? Maybe the Aussie's going well or whatever it happens to be, but something happens to the US dollar and it significantly affects the market. All your eggs are in one basket and all of your trades are going to suffer. I mean, they might all benefit. But the thing is, we are not gamblers here, okay? This is a business. We're professional traders. That's how you want to have your mindset anyway. And until you are a professional trader, and a professional trader is a person that makes money consistently. Okay. Doesn't matter of your education or what's happened in the past. If you are making money consistently over a long term, then consider yourself a professional trader. You don't have to work for some, corporate giant or investment bank or whatever to consider yourself a professional. So have that mindset from the morning. If you're working from home, go through the work process in the morning. Shave if you're a guy, or do whatever you are to keep a professional mindset. But back to the point, are all your eggs in one basket? If you're all trading them against one particular currency pair like the US, then they're all in the same basket. Another example is, let's say you've got two positions open in the euro, it's going well, and then you tighten your stop on both of them to the same stop. Well, then all your eggs are in one basket. Okay, it might be profitable. You've locked in profits. You've done the right thing. But if it moves against you and both those trades get taken out for profit and you've banked some of your equity into capital, that's just great. But what if the trade continues to move in the direction that you had intended for like another 50 or 100 pips, you'll be thinking, oh no, and all you had to do to not have your eggs in one basket is don't set the same trail stop loss. Don't set the same trail, don't set the same stop loss for both positions. Have one tighter, have one a little bit more liberal. That way you're trading offensively and defensively at the same time. Okay. Or another way of looking at it is you're trading conservatively on one, keeping your stops really tight, and you're being a bit more liberal on the other one. Okay, so if it does go a little bit against you and then moves in your direction, then it might take one of your trades out. That's great. You've banked that equity in the capital and you've got another position open. You're still in the party. You're still in the game. Way to go. Don't keep all your eggs in one basket. Applying good quality trade management will help reduce risk and maximize your profits. Okay, you'll hear me talk about it again and again. Trade management is what it's all about. Okay, money management, of course, perfect setups and entering your trades according to the systems, yes. But then when you're in the trade, it's not over. Okay, you still have to manage that trade, or if you've got two positions open, manage those trades. Okay, and that will help you reduce your risk and maximize your profits. So, as I was saying just before, if you're going to tighten your stops, tighten them to different stop levels. So at least you have the opportunity to maximize your profits. Okay, you will be surprised. One might be taken out for, let's say it's up at around 45 pips, and you want to manage your trade again, and you lock in say 35 pips, so you got 10 pips room on one trade, but you only lock in say 20 pips or 25 pips on the second position. You got a little bit more room to move. Takes out one, banks your equity into capital, converts your equity into capital on the one position, and then the trade goes on for another 100, 200 pips. Fantastic. That's what it's all about. When you get a winning trade, these trades, you shouldn't be trading all the time. Don't overtrade, on a side note. But when you are on a winner, you want to stick on that winner for as long as possible. You want to hang on to that bucking bull for as long as you can, because the longer you hang on, the more you are going to make. Never risk more than you can afford to lose. Okay? It's simple. I don't know if I have to go into it any more than that. But, if you can't afford to lose 200 or 500 or whatever it happens to be, as I was saying before, regarding your tolerance to risk, then don't risk it. Okay? I know things may be, you may be in a situation, you may be really keen, eager, anxious, desperate even to make a lot of money in a quick amount of time, and you've bought Forex Precog and you want it to work for you. That's great. But remember that trading is a journey, and that if you risk more than you can afford to lose, you're going to be out of the game and on the sidelines quicker than you can fill in the blank. So don't risk more than you can afford to lose. Slow and steady wins the race. Alrighty, thank you for watching and listening. I look forward to seeing you in the webinars. Don't be shy, come along, and we're going to have fun together. Good trading, live well, and I'll see you soon.